Blink Charging was once one of the hottest stocks on the market, and now the company's very survival is really in question as the pace of electric vehicle adoption slows, the charge port and the charging network itself becomes commoditized. Remember, a charger is putting a commodity, electricity, through a largely commoditized plug or standardized plug. Most of that's moving to NACS in the US. And that means that anyone can create a charger, anyone can create a charging network, and any electric vehicle driver can plug into any of those networks. There's no exclusivity here. So that just fundamentally makes the business very difficult. And the company is trying to get its operating costs under control, increase services revenue. There's momentum on both of those pieces. Those are both positive things, but there's a cost to cutting those operating expenses, to pushing to more services revenue. And that's that revenue growth has basically stalled out. So I want to go through what we learned in the recent second quarter earnings results and show why I think this company is still going to struggle to survive long term. I don't think it's going to be able to get to profitability or adjusted EBITDA positive like management thinks in 2025. And that leaves very, very little upside for investors. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I'm going to use the company's presentation as a guide here because I think it lays out what they want to do and then fundamentally the problem that they're going to have getting from that strategic vision to an actual operational profit from a business perspective. This is the earnings presentation, and I'm going to flip back between this and the press release, which gives a little bit more granular detail but this really gives an idea of what the story management wants to tell is. So the company, $33.3 million in revenue, just a 1.3% increase in total revenue. I'll get to the breakdown of that, but they're actually selling fewer chargers. There's basically two pieces of the business. You sell the charger, that's a vast majority of Blink Charging's revenue. Same thing with its competitors. And then there can be services that go along with that, network services. They actually go into that here. Services revenue consists of charging services revenue, network fees, and ride sharing revenue. So that increased 15% to $8 million. But overall, like I said, the sales were relatively flat. Gross margin improving, and I'll get to that and the reason for that in a second. Now, the story for Blink was always that they were going to increase the deployment of chargers. Look at this chart here. This is the Blink chargers contracted, sold, or deployed. So this is basically the largest number on an absolute basis that they can give you for the number of products that they're actually getting into the market. And look at the way that this curve flattens out towards the top. So you get a higher growth rate in electric vehicle adoption early on. We want to see this compound over time and these numbers go up in an exponential manner. But what they're doing right now is it looks like they're flattening out. And that's not a good sign for the revenue growth overall for the business. And you can see that here in the numbers. Product revenue down 4%. That services revenue is growing. That was up 15%. And gross profit just $10.7 million. The reason this number is important is because it has never come anywhere near covering the company's operating expenses. Those operating expenses, even after dropping from $53.4 million a year ago, were still $31.4 million. So that gets you to the GAAP net loss of over $20 million just for a single quarter. Adjusted EBITDA, which takes out some of those one-time costs, things like stock-based compensation, depreciation, that is still negative $14.7 million, and the EBITDA margin is negative 44.2%. Just a crazy number to be that negative on an EBITDA margin perspective. But like I said, they are improving their operating expenses as a percentage of revenue. 2023, over 100% of revenue was operating expenses. Look at that improvement, now just 88%. That number actually needs to get down to more like 20% or 30%. That is fundamentally the challenge for Blink Charging is can you cut costs that much? Because one of the big pieces of operating expenses is sales and marketing expenses. What happens when you cut sales and marketing expenses? Your revenue growth slows. So we're seeing revenue growth slow. We're also seeing operating costs come down. These are the consequences of these two decisions. They do have pretty high expectations for the future, $145 to $155 million in revenue, really solid gross margins, and then positive EBITDA on an adjusted basis in 2025. This is what I would question right here is if they can actually cut their expenses enough to get there and actually keep that revenue growing. But here's the other challenge for Blink Charging. This is the balance sheet. And this is the wall that they're going to run into as their stock price continues to fall. So right now they have about $74 million worth of cash on the balance sheet. That is down from $121.7 million a year just 6 months ago. So those losses eat into your balance sheet. There's not really any debt or anything glaring on the balance sheet from an operating lease or a financing lease perspective. So on the liability side, that's good. But is there enough cash to get to cash flow positive? And if there is that cash flow positive going to be even meaningful when they get there? And I think that's why you see the stock dropping like it is, down 66% in the past year. You can see that shares peaked over $50 per share during the pandemic, now down to just $2. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So you have a couple of challenges here. There's the near-term challenge of, can Blink Charging continue to grow its revenue enough and cut its operating costs enough, do both of those things at the same time to get to adjusted EBITDA positive, which would be a proxy for being free cash flow positive. That they think they can do in 2025. I don't know that they're going to be able to get there, in large part because of that commodification of the product that they're selling that I talked about earlier. The second thing is the balance sheet is a challenge. So you are going to incur losses over the next few quarters. Those losses are going to eat away at your balance sheet. Your balance sheet gets worse, you need more money. How are you going to raise money if you're Blink Charging? There are two options. There is equity, so you could sell stock to raise more money, but the current market cap of the company, about $200 million. The share price is $2 per share. Any sort of stock sale announcement is going to send the stock lower. It's going to dilute you even more. And I don't know that it fundamentally changes that first question is can you actually get to profitability? You could also choose to raise debt. You could go to debt markets and say, we'll do a convertible note, we'll do senior secured, but our debt market's going to be interested in funding a company that is losing money and has a falling stock price. The answer may be no. And this is the fundamental challenge for a company like Blink Charging. Even if you're not interested in Blink Charging itself, the example is really good to understand, because you have to understand that Blink Charging is making a physical product. They are making a charger. They have to make money on that charger, the initial sale of that product, and then they also want to add revenue from services in the future. So as an investor, you have to look at, can they actually do these things? And this is the reason that I've been negative on Blink Charging for so long on this channel, is because they're not making a profit on that initial charger, and they're not making enough services revenue or adding enough value on the services side. And it doesn't seem like that volume is increasing fast enough. 15% growth rate is fine, but it's off a very, very small base. And it's not clear there's any differentiation or any network effect from the actual network that they're building. So where in the world are you going to add value if you're Blink Charging? Where are you going to have profitability coming from? Revenue growth, higher margins. There's really no clear answer. And this is the challenge for Blink Charging and investors. And I don't think there's any way out of this. And Blink Charging isn't alone. I don't think any of these charging companies are going to be in a very good position, because they are fundamentally commodity companies selling a commodity through a commodity plug. That's not where you want to be in the market. It's just not a high profitability, high growth place to be, despite the fact that EVs were growing. Now you get the headwinds of slowing EV growth. Maybe we don't need quite so many chargers. So I add all of this up, and this is a stock that I would absolutely avoid. And it's gotten so small that it's going to be even harder to finance the company in the future. So let me know what you think about Blink Charging and the future of charging stocks in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.